Dubravko Lakos. He's the global head of equity macro research, JPMorgan. It's been a while. Welcome back.
Thanks, Scott. Good to see you.
You as well. Your headline today is market internals point to an extremely bearish setup. However, you have a 4,900 price target on the S&P. You still have earnings at $230. You say valuations are getting increasingly more attractive. Multiples have already adjusted to rising rates. I mean, that doesn't sound like your narrative is extremely bearish. So where's the disconnect?
No, I don't see a big disconnect. You know, when I basically look at the fact that investors are paying an arm and a leg for defensive stocks, that just tells me that positioning is very bearish, and I would be basically looking to the other side. That just tells me that sentiment is very negative, tells me that position is very negative, and people are basically positioned for recession. Our base case is this is not going to be a recession in the next 12 months. That's our house view. And so we think from that angle, the portfolios are wrong-footed.
I mean, I don't want to put you in a difficult spot because, you know, you might see Jamie in the cafeteria from time to time, and he may wander by your office and vice versa. But what do you make of he sounds like somebody who would not have a 4,900 price target on the S&P, nor that earnings were going to hold up to the degree at which you do, nor that he thinks valuations are all of that attractive now, and that maybe we've adjusted to rising rates, because he talks about one of the principal reasons for his worry is Fed tightening and never having had QT like this, quote, end quote.
Yeah, so I think Jamie says, right, there's a storm coming. We don't know if it's a mild storm or if it's a severe storm. I think the market is already discounting and pricing in something more than a mild storm, and we don't think it's a severe storm. So again, 4,900, that's our year-end price target. Between now and then, that's 7 months. A lot can happen. We need to see what happens on inflation side. We need to see if Fed goes restrictive or if they pause somewhere around neutral rate, in which case positioning being so bearish, I think you're set up for a potential reversal.
Why? That's what I'm trying to get my arms around. Why? When everything seems to suggest, as Steve Weiss said as well, we're in a very difficult environment. And the unknowns, I would make an argument, skew to the negative rather than the positives. I mean, could there be an unknown positive coming out of the war in Ukraine? Sure. But the other unknowns skew negative, don't they?
No, I would actually argue the opposite way. I think that a lot of the unknowns, most of the unknowns are there. I think the backdrop has basically gotten hit from all sides, from basically just about every angle. And so I think the big unknowns here is really, do we have some form of, I don't know, further escalation on the Ukraine side where, I don't know, Russia decides to, completely put a halt on natural gas, and then Europe goes into recession. That's an unknown. That's a tail risk. It's not our base case. Another unknown could be, could we see more hedge funds going basically belly up that were riding the tech wave? That's an unknown, but I think it's very hard to put a base case on those. So we generally, when we look at the economy and when we sort of look at the current backdrop, are we going into a slowdown? Yes. Are certain parts of the economy on the good side going to go into recession? Yes. Arithmetically, they have to. But I think the broader backdrop, to me, doesn't suggest a full-fledged recession. It suggests at most a technical recession. And I think the market is pricing in a pretty heavy dose of negatives already. And so that's why I would almost be asking the other side of the question.